at fair value gaps, or rather what is called imbalance, or in other terms, people call it liquidity voids. Then the next thing we look at is what we call a stop hunt. Then lastly, we are going to look at the Quasimodo pattern and mention a few things on Confluences. So let's start it off. Before you even start it off, who can someone to tell us the POIs that you've learned already? Someone to mention any POI that you've learned already? POI that you've learned already? Any POI? Someone to mention any POI that you've learned already? Sly?
Order block.
An order block, that's correct. An order block. Someone else? An order block. Any POI that you can remember? An order block. Someone else? Pius?
Flip zones.
Flip zones. Flip zone is not quite a POI. Not quite a POI, but good trial. Joseph?
Breaker block.
What? Pardon?
Breaker block.
Yes, breaker blocks. Breaker blocks. Another one that you've learned so far. Another POI that you've learned. Last one. Okari, again.
Support and resistance.
Yes, support and resistance. And just to mention the last one is the market structures. So on today's class, we are going to learn another POI or two other POIs. That is the fair value gap, FVG, and the Quasimodo pattern. So let's start it off with the FVG. So what's an FVG? An FVG is what we also call a liquidity void, or other people will call an imbalance. So this is insufficient trading in the market, and it happens when the market moves aggressively in one direction, creating a gap or imbalance. So when there is insufficient trading in the market, price oftenly comes back to fill that gap, and this is because there were less buy orders being paired with the sell orders and vice versa. Basically, this is what we are saying. But anytime there is insufficient trading in the market, what do you mean by insufficient trading? For example, this stretch from right here to right here, we can consider that as insufficient trading because this period we only had buys without sales in the market. Only buys without the sales in the market. And thus, we call that an imbalance. An imbalance. And now that we are being told that when there is insufficient trading in the market, price will often come back to fill that gap. Like you can see right here. Because of this insufficient trading where you only had buys, but we explained Jana in layman's terms. What did we say in layman's terms this means? Someone said mitigation. Another person said price is coming back to fill the orders, the buy orders. But in layman's terms, what did you say this is? In layman's term, what did you say it's happening in the market at that particular juncture? Pius?
Profit taking.
Yes, profit taking. Remember, people bought right here because price was at a discounted price. So the action of them buying at this price made the assets or the price of this asset go up in price. And this means now the investment that they made right here is now in profit. So what will happen? Price will come down because they're collecting profit. Remember, the action of collecting profit is actually selling that asset. So as they're selling, the price will come down again. And why is it selling up again? Because now price has gone down and it's at a discounted price. So people are buying in again. Remember I said, for us to invest in a cryptocurrency, always buy when the market is red. And no wonder there's a statement that says, be greedy when others are fearful, and actually be fearful when others are greedy. So back to the imbalances, we are saying that the moment there's insufficient trading in the market, price will tend to come down to fill that imbalance. So price coming back to fill that gap is referred to as mitigation. mitigation. So the action of this price actually coming down to fill this liquidity gap, then, or rather to fill this FVG, then that is what we call mitigation. So, however, mitigation is not a must to occur, as this will depend on other factors such as fundamentals. So, and not better trading is about speculation and probability. But just to explain, remember I keep on saying that fundamentals in crypto are more respected, or are more, they carry a lot of strength in comparison to the technical analysis. So mitigation is not a must for it to happen, depending on other factors like fundamentals. And I'll give an example. Let's say this was Doge, a really simple example. Let's say this was Doge. Then we had a pump right here, and the market created this gap, or FVG. So technically, we know that once an FVG has been formed, then price must come down to fill that what? To fill that liquidity void. But assuming that Doge pumped like this, and when it was at this level, probably Elon Musk, or we had positive fundamentals on Doge, do you think price will come down to be mitigated, or price will go up? Someone, let's say Doge has pumped, then technically we know that it's supposed to come down to fill this liquidity, but Elon Musk tweets something positive about Doge. Do you think it will respect the mitigation and come down to fill that liquidity void, or the pump will continue? What do you think will happen to the market? Do you think it will pump, or it will come down to fill that liquidity? Joseph?
The pump will continue.
Why?
Positive fundamental analysis.
Yes, fundamental analysis are stronger than technical analysis. And no wonder you're saying that it is not a must for mitigation to occur, based, or rather depending on other factors as fundamental analysis. So how can we identify fair value gaps in the market? So a fair value gap, or a liquidity, or an imbalance, is a 3-candle pattern where there has been a move in one direction that leaves that gap on imbalance visible between candle 1 and candle 3. Someone will ask, what do you mean by candle 1 and candle 3? And this is where this diagram comes in. So we are having 2 candles following each other, candle 1, candle 2, and candle 3. So if there is a gap in between, consider candle 1, from the wick, from the topmost part of this candle 1 to the bottommost part of this candle 3, if there's a gap right there in between, that is what we call an FVG. Let's go to a situation of a downtrend. In a downtrend, we have 3 candles, candle 1, candle 2, candle 3. So if we have a gap in between the first, the bottommost part of the first candle and the topmost part of the third candle, if there's a gap right there, that is what we call an FVG. Let's look at FVG without wicks. This was with wicks. Let's look at FVG without wicks. The same thing. The bottommost part of that candle, of the first candle, and the topmost part of the second candle, if there's a gap in between, that is what we call an FVG. Same thing for a downtrend. The first candle, the topmost part of the first candle and the bottommost part of the third candle, if there's a space there in between, that is what we call an FVG. And just to look at a few examples, if I'm to come to this part right here, we can see a number of things. Let me start from yesterday's class. This is the part that we did yesterday in class. So let me just delete this part and see, delete 9 drawings. So if I'm to come to this part right here, we can notice a few things. We have said that an FVG is if there is a space between the topmost part of the first candle and the bottommost part of the third candle, then that is an FVG. And you highlight it using a rectangle from the topmost part of the first candle and the bottommost part of the third candle, like that. That is what we call an FVG. FVG. Let me just name it. FVG. Sly, you have a question?
Yes, I'm still struggling to understand what you're saying.
Okay, the bottom, let me repeat that again. The bottommost part, let me look at an example that we don't have an FVG so that you can understand. Let's look at these three candles right here. Remember, three candles that are following each other. So I want us to look at these three candles. This green one right here, this green one, and the red one. Okay, Sly? The green, two green ones, and the red one.
Okay.
You see those three? Let me zoom
Yes.
them out like this so that you can see them. So that you can see the difference of it. So if you look at the, remember, it's the topmost part of the first candle and the bottommost part of the third candle. So if you look at that, the topmost part of this candle is this one right here. Okay?
Yeah.
You see that?
Yes.
The topmost part of the first candle is that one. First candle, second candle, third candle. Let's look at the third candle. The third candle, the bottommost part of the third candle is this one. So there's no space there in between. It's fully filled. But if you look at this example that I've highlighted right here,
and the candle that the candles you select is where like there's a change of direction.
What do you mean by change of direction?
Like this one that you're showing, the trend was downwards, now it is going upwards.
No, any three candles, I want to understand when it comes to an FVG, any three candles that are following each other, if there's a gap there in between, then it qualifies being an FVG.
Okay.
Joseph, you have a question before I continue?
Yes. For I've been following that for let's say bullish FVG.
Yes.
Three bullish candles, green, green, green.
Yes.
And for bearish,
Okay.
three red, red, red. But the slide has showed that the red one, the bearish, there is one green and two reds. Is that a valid FVG?
Yes, it's a valid FVG. You know what I'm saying? Any three candles that are following each other and there's a gap there in between, it qualifies being an FVG.
Note that for the bullish, only bullish candles and for bearish, the only bearish candles.
No, any three candles that are following each other and there's a gap there in between, it qualifies being an FVG.
Okay.
Is that okay?
Very okay.
I'm saying that to generalize everything because there are different types of FVG, but just to cancel out at all these terminologies, it's easy saying that any three candles following each other and there's a gap there in between, it qualifies being an FVG. There's no need to learn all these technical terms or read the different types of FVG. Just understand three candlesticks following each other and there's a gap there in between, it qualifies being an FVG. So back to this, I want Sly to understand the difference between these two. So if I come to now these three candles, this first doji, this other one looks like a bullish 7, and this other one right here. So if I look at the topmost part of the first candle, it's right here. Topmost part of the first candle. And the bottommost part of the third candle is right here. Sly, can you see that?
Yes, I can see it.
So there is a gap here in between. If you can see that, there is a gap there in between.
Okay.
So if you look at these two, there's no gap in between because the first one is up here and the second one is up here. So there's no gap there in between. Let's look at another example. If you look at this, Sly, tell us these three candles, this timber, this one and this one. Is there an FVG in between?
Yes, there is.
Yes, there is. Correct. Because if you look at the topmost part of this candlestick and the bottommost part of this third candlestick, there's a gap there in between, and you can highlight it using a rectangle and call that what? An FVG. An FVG like that. So if I extend, and we've been told that in most cases, mostly, remember mostly, not all the time, mostly the market will come down to fill that void. And if you look at that part, it actually came down to fill that void, FVG. It came down to fill that. If you look at this other one, the market actually mitigated that. If you look at this other one, let's look at three candlesticks following each other. Sly again to make sure you understand.
When you say the market came back to fill, what do you mean? Like using the example on the extreme end, right?
Mitigating. Remember I said this action, let me go back to the slide. Right, what's this? Remember this part right here?
Yeah.
So this is a perfect example to explain. So we have two confluences actually in this part right here. The first one is what we covered yesterday, and that means is and in that case is the bullish order block. So it market come into the zone of the bullish order block before buying. But the second confluence that you're having right here is the FVG, and you have said an FVG is a liquidity void. So or rather an imbalance. So because of this imbalance caused by the buyer, the sellers must come down to fill that what? Fill that imbalance. And the action of the market coming down to fill that imbalance is what we call liquidation. Coming back to my slides right here, same thing. So there's an imbalance that was caused here, that was left here behind, or a liquidity void or an FVG. So the market will come down. In most cases, it will come down to fill that void. And you can see, so it can fill the whole of it, like it did in this presentation. Where is it? In this one, the void was filled, all of it. But it can also feel like this. So no wonder we said there's some people who will consider an FVG from the top right here. There are some people will take their trades from the top right here, the topmost part of an FVG. There's some people will take 50% of an FVG, 50% like that, and there's someone who's gonna consider the bottommost part of that FVG. But in this case, the part that was respected was the topmost part of an FVG. If you look at this other one, the mitigation fully filled that FVG. Play, you've gotten what I'm saying now?
Yes, now I've gotten. And that tool you used to do 50% is the gunner.
Yes, the gun box. This one right here.
All right.
Okay. So if I come to this part, let's consider these three down candles, the first one, second one, and third one. So the first candlestick is this one right here. Then the second candlestick is this one right here. So there's a gap there in between. So it qualifies being what? We'll highlight it like that. So it qualifies being called an FVG. And if you extend it like this, you'll see price actually respected that. It came, it was respected multiple times. The first one, it was tapped, and the second time, and finally it was fully bridged across. So you can identify different FVGs in the market. There are some that won't be filled. We've talked about different, for example, this one right here wasn't filled, wasn't mitigated. Let me use the correct terms. If you look at this one right here, it wasn't mitigated. Even if I extend like this, you'll notice it wasn't mitigated. But there are some that were mitigated. If I draw this one, I've just seen it right now. If I draw this one right here, you'll see this one was mitigated. Is it this one? Let me see. No, actually not that one. But this one, let's look at this one right here. This one. If you can see it, thumbs up. Yes, this one was actually mitigated at that juncture. So if you can comfortably identify FVGs in the market, thumbs up. Thomas, you have a question?
Yeah, I'm wondering, when the market is not mitigated, what does that mean?
Pardon?
I'm wondering what is the meaning when the void is not mitigated.
What it means if it is not mitigated?
Yes.
It means that it is not mitigated. Price did not come down to fill that void. And when I say not all of them will be mitigated, not all FVG. And if you look at this part, I've said mostly, not all the time, mostly. Where is that part? However, mitigation is not a must to occur, and this will depend on other factors such as fundamentals. So I want you to understand, none of this be trading is about speculation and probability. It's not an assurance of anything. So it's about speculation and probability. I hope I've answered you.
Perfect.
Yes. Pius, you have a question? I can see your hand is up.
I wanted to answer him.
Okay, please do.
The extent is went is none.
Mm-hmm. Continue. Pius.
Yes, be liquidated.
Okay, let's have Joseph.
FVG means that the price might come back to fill that gap, meaning it might back to collect that liquidity and continue. So you combine an FVG maybe with an order block and maybe with an AMD, then you can conclude that this is a valid FVG.
Yes, yes. No wonder I'm saying that trading is about probability. And for you to make sure that your speculation is very, very close to what the market will do, then you have to have confluences. Combine market structures, combine an order block, combine FVG, combine a QM. Then with all of that, your probability will be higher. I hope that is okay, Thomas.
Yes, it's very clear. Thank you.
Okay, so how do we trade an FVG? We have tackled that already, but just to mention, on most occasions, the price tends to come inside the FVG before making an impulsive move. So just like an order block, the price will tend to come, mostly, will tend to come back into the zone of the FVG before making an impulsive move. So one can always have an entry where we have an FVG so that one price comes inside, they get activated and the trade goes their way, just like an order block. You can have your entry or exit point from an order block. And when we said an order block is a POI, same thing to an FVG. An FVG is a POI, and by POI we mean point of interest, and we mean it can either act as an entry or an exit to a trade. This is basically an example to counter that, an FVG in an uptrend. Someone to tell us, we have two confluences right here. The first one is the FVG. Which is the second one? Actually, we have three confluences. Any that you can identify. Remember, we are having an uptrend right here, and this is the zone. If you can see this blue part, this blue or white, this FVG that has been highlighted, we can see that thumbs up. This part right here. So any confluences that you can see, any confluences that you've learned so far, you can see, apart from the FVG that you're learning today, any other confluence that you can see? Pius?
Resistance and support.
Resistance, I hadn't seen that actually. So maybe there are four. Yes, resistance and support. You've made me see that. Resistance and support. We'll tackle them, all of them. Just mention resistance and support. Another one, someone else? Abby?
Bullish order block.
Yes, a bullish order block. Good one. Let's have someone else. Let me see who is here. Another one. Please, your hand is up for the second time, or? Another one. Okay, let me just indicate it right here. Remember, this is an uptrend. Abdi, you can take it away.
Can we say higher highs and higher lows?
Perfect. That is what I was looking for. Let's appreciate Abdi and Pius. Yes, higher highs and higher lows. But in simple terms, what Abdi is saying, we talked about an uptrend and we looked at how to trade an uptrend. What do you say is the best way to trade an uptrend? Someone, so that we can have a refresher. What is the best way to trade an uptrend? The best way to trade an uptrend. You mentioned that last week. Joseph?
Wait for pullback.
Yes, wait for a pullback. Remember we said an uptrend is a series of higher highs and higher lows like that. So we said if you want to trade an uptrend, wait for a pullback as the market is coming back to form this higher higher low, a low, but it is higher than the previous low, so it's a higher low. As the market is coming down to form that higher low, then you can use that as your point of interest. And that is what was happening in this chart. We're having our higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. So basically this is an uptrend. So what you're supposed to do in this setup right here, we are waiting for the market to come down. The first thing is an uptrend. We are waiting is an uptrend. So what are we timing? We are timing as the market is coming down to form a higher low, then we can have our entry at that juncture. So how do we determine where this higher low will be at? Or rather, because it can be at that point, it can be at that point, it can be at that point. They're all higher lows. So to increase our probability, we add on other POIs that we've learned. So from this leg right here, we look for things like order blocks, FVG, and stuff like that. So if you come to this part right here, we don't know where this higher low will be at, but coming back on this leg right here, the number one thing that you can identify, or the number one POI that you can identify, is an FVG. We are having an FVG. And to confluence that, we have what? Our last red. Remember, this is the last red. Black in this case is a downtrend, and white in this case is an uptrend. So this black right here, consider in your mind as a red candle. So our last red candle before significant buy is what we call what? Last red candle before significant buy is what we call what? Someone? Last red candle before significant buy. Pius?
Bullish order block.
A bullish order block. So how many confluences do we have so far? We have features of how to trade an uptrend. So you're having an uptrend, or what Abdi called higher highs and higher lows. Doesn't matter however you call them, as long as you understand. We have that as the market is coming down to collect, or rather to form a higher low. That's our first confluence. The second confluence is what has been highlighted right here, which is an FVG. Then the third confluence is what? An order block. An order block, and just not any other type of order block, but a bullish order block. So three confluences together. So if you draw a rectangle from this part to this part, yes,
you're calling it a bullish order block even though it is red.
Yes, that's how we defined it, a bullish order block. We say that the last red candle before significant buy is what we call a bullish order block. And you can see that from the zone of the bullish order block, we experienced a buy from the term itself, bullish order block, buy from that zone right there. So that's how you increase your probability. I hope, Thomas, now you can see what you're talking about. Thomas, you can see what you're talking about? To increase to increase your probability, make sure you have two or more POIs that are confluencing each other. Let's look for a case of a downtrend. Same thing right here. This is a downtrend. A downtrend right here. We are having an FVG right here. So, which type of order block is this one right here? Not even order block. What is this? What is this right here? Is that trick question there? Let me just do it right here. Okay. Yes, Joseph?
Bearish breaker block.
Exactly. A bearish breaker block. Not an order block. A bearish breaker block. Can you explain why? Maybe you will understand from your definition. Why is it a bearish breaker block? Or rather, what is a breaker block? Joseph, what is a breaker block?
Invalidated order block.
Yes, an invalidated order block, or rather what we call a disrespected order block. And why is that? Okay, let's break it down pole so that you can understand what you're talking about. So the last red candle, ignore everything that you're seeing in the chart right now, just concentrate on this part right here. We're having our last red candle before significant buy. Last red candle before significant buy. What did we call that? Someone? Last red candle before significant buy. Slide. You've
Is it a bullish order block?
a bullish order block. So what do you expect from a bullish order block? Price to go up or go down?
To go up.
Perfect. So we expect that the price will come into the zone of the bullish order block and experience a buy. But what happened? It disrespected that part. Slide back to you so that you can understand. Disrespected bullish order block becomes what? We did that yesterday. A disrespected bullish order block becomes what?
A breaker block? Or?
Yes, a breaker.
Can't remember.
Okay, someone? A disrespected bullish order block becomes what? Yes, it becomes a breaker block. But which type of breaker block? Which type of breaker block? Levy?
Bearish.
A bearish breaker block. Exactly. A bearish breaker block. And no wonder we say that this candlestick is not a bearish breaker block. And what do you expect from a bearish breaker block? To experience a selling pressure. So that's our first confluence. Our first confluence. Any other confluence that you can see apart from the FVG? FVG has already been highlighted. So far we have our bearish breaker block and we have our FVG. The third confluence that you can see from the chart. Joseph, I see your hand is up.
A question.
Okay, a question?
That is it's supposed to be a bullish order block, but it turns to be a bearish breaker block.
Yes.
How many, for example, for the bullish breaker block from the red candle, how many candles can you count for it to be valid an order block? Can one bullish candle be a valid order block or 2 or 3?
I'm not getting you. Rephrase yourself again. Pardon.
A bullish order block is from the last bearish candle, yeah?
The last red candle before a buy.
Yes.
Yes.
How many candles or buys can you consider to be a valid order block?
Just one. This last one. Oh, what are you talking about? Let me see.
Okay. That candle, let us assume that doji and that the top green candle are not there. And the price comes back to that red candle. Can that be an order block?
So let's go back to how we define an order block. We say that order block is the last candle before a significant move. Okay? The last candle before a significant move. So
yes.
How will we define significant move? Volume, right?
Yes.
A significant, for something to be called a significant move is on the volume, okay? So if it's on the volume, what do we look for? Either candles following each other, multiple candles following each other, or one candle that has big what?
Body.
Yes, big body. Why a big body? Because body represents what?
Volume.
Exactly. What else do you know? Okay, perfect. I see a thumbs up. Okay, perfect. So I was talking about in this chart right here, we have identified our first confluence, which is a bearish breaker block. Then our second confluence, which is the FVG, which is our third confluence. Someone, our third confluence, if you can see it, if you can see it, unmute yourself and mention it. Our third confluence. A try, even if you'll be wrong. A trial?
I would say lower highs.
Yes, lower highs. Lower highs. And I'll repeat that again. Am I confusing myself? Is it lower highs? Let's just see. So we are having a downtrend like this. And we say, just like in an uptrend, we say that the best way to trade an uptrend, so a downtrend is made up of lower highs. Yes, it's lower highs. I confuse higher lows and lower highs. Yes, this is a lower high. It's a high, but it's lower than the previous high. So it's a lower high and lower lows. And we said the best way to trade a downtrend is to wait for the market as it's coming up to form a lower high. You can have that as your point of entry. That's the same thing. This market was making lower highs and lower lows, a downtrend, lower highs and lower lows. So what you are waiting to see is the market to come back. As it's coming back to form a lower high, then you can have that as our entry. So that's our third confluence. So we have lower highs, we have the bearish breaker block, then we're having our FVG. And that's why we see that the market came, respected that zone, because that zone we have 3 confluences, that zone right there, and it sold from that juncture. Let me go to an example that I was doing. Was it on the 1 hour time frame or 15? Let me see. Was this one right here? Let me just check from my other trading view that can explain a very good example of confluences, a different type of confluence. Let me see. Let me just check it out a minute so I can see which time frame it was on. So it was BTC USDT on the what time frame? Let me see. Oh yeah, perfect. On the 1 hour time frame. So let me go back to my 1 hour time frame. See if I can identify it again. Yeah, perfect. So let's do this. Okay, we are having a ranging market. Actually we did this yesterday in class. So this part right here is what? An accumulating market. An accumulating market right there. What do you say about an accumulating market? What is the best way to trade an accumulating market? Someone? An accumulating market. What is the best way to trade an accumulating market? Someone? Sly?
Support and resistance.
Okay, there's support and resistance. Is that okay? But I'm talking about the best way to trade an accumulating market. Joseph?
Wait for manipulation to occur and point.
Yes. So we said that is called, the best way to trade an accumulating market is to use the week-off strategy. And basically the week-off strategy is the classic AMD accumulation. You've identified the accumulation. The aim is wait for a fake move. We have seen that fake move already right here. That is the Judas swing, fake move, or in our terminology AMD, the manipulation move, manipulation like that. Then trend what? The distribution. The distribution is always the direction that the market will take that is opposite the what? The manipulation move, the distribution. Trade the distribution. So in this case right here, if I let me move to maybe 15 minutes so that you can see it clearly. You can see the fake move clearly. So you can see that the market was accumulating in this zone, accumulated, and we said accumulation is, it is playing within the zone of the support. This is the resistance, and you're having our support right here. So the price is playing in between those zones, the support and the resistance zone. So if it breaks on the either side of the support or resistance zone, we consider that as a fake move. So this one right here is a fake move, and we defined a fake move as a Judas swing, or rather a move that is basically to induce or to lie to the traders that the market is actually going up. But in real sense, what is gonna happen, the real direction is the downtrend, or the move that is opposite the fake move. Accumulation, manipulation, the manipulating move, then you have the distribution. So the best way to trade an accumulating market is the classic AMD. So you have identified that as the first thing. The first thing you have identified, or our first POI, is what? The classic AMD. Let's look for the second POI. The second POI we can do is that we know that the market is gonna go down. So in this case, we are looking for a short position like this, a short one. So what we are looking for is a zone on this leg for us to sell from that zone. And you can see from this zone right here, we are having what? Who can tell us which type of order block is this? Someone to tell us which type of order block that is.
FVG.
Not quite. The one that I've highlighted, this last green candle before a sell. Last green candle. Anyone, just unmute yourself. Last green candle before a sell.
Bearish order block.
A bearish order block. A bearish one. A bearish order block. So we are looking for a sell position from that zone. Which is our next other POI? We're having an FVG. Remember I said an FVG right here. If you can see that FVG, thumbs up. This one right here. Yes, we're having an FVG. So we're having a bearish order block and you're having an FVG from that zone. So you're having three POIs that are confluencing each other. The classic AMD, the FVG, and the bearish order block. So you can have a sell from this zone right here. But remember, this just to confluence each other. But do you think BTC will go down? Someone to tell us. Can have maybe 50% of the both of these. Let's have just 50% of the both of these, because they are confluencing each other. So you can have our entry from this zone right here. So far, can someone, do you think BTC can go down? But anything can happen in crypto anyway. Do you think BTC will go down, someone? And to give us your thought, do you think it will go down or it will go up? And you can have maybe your take profit from this zone. This zone. Remember, I said an order block can be used as a POI, and by POI we mean an entry or an exit to a trade. So you're having our last red candle before a buy. So you're having a bullish order block right here. And you can use a bullish order block as our POI, as our take profit, like that. So, Sly, tell us.
It can go up or go down. Let's say, for example, if a missile is thrown in America, maybe it will go down. So the fundamentals can, depends on the fundamentals. It can go down, but eventually it will come up.
Yes, it will come up. Definitely. BTC is gonna down. It's inevitable. It's inevitable that BTC will go up. But in this scenario, according to today's fundamentals, what you have said is very correct. But according to today's fundamentals, if someone has been thinking today, do you think BTC will go down or go up?
It will go up because we're in the bullish cycle.
Yes, in the bullish cycle. Actually, I think the probability of BTC going up is higher because of the fundamentals that are around today. But who knows? Anything can happen. But technically, if the market was supposed, if it was supposed to follow our technicals, we are correct. The market is, the BTC price is supposed to fall down up to this zone, then go up to that zone. But remember, I said in crypto, fundamentals are stronger than the technicals. So, any question up to that part on FVG and confluences? Any question on FVG and confluences? I want to end this class at this time. I'm going to tackle Quasimodo patterns tomorrow because I have another meeting at 10, exactly 10. So we can do the second part of this class tomorrow, which is the QM, the Quasimodo patterns. Live.
I just think the indicator that you've used, the one that has a green and red.
Yes.
It depends which one. It's Fibonacci.
Pardon, which one? This one?
No, like on the extreme right, that one. Yeah.
This one?
Yeah.
No, this is the position tool.
Oh, position tool.
And this is the short one in this case. The short one. Remember short. If I start going short, what does that mean, like?
So it means that you put your first the cursor on the top where you want to put the first price, and the take profit. You drag it down to where you so it's short, like it's you're selling something like that.
Yeah, perfect. That is like that. Or I expect the market to go down. So when I'm saying I'm short, I expect the price, or what I think I expect the price of that asset that's I'm selling. But when I say I'm buying, I'm going long, it means I'm expecting the price of that asset to go up. Are we
So in this, so in this case, how did you determine where to put your selling price and your buying price and selling price?
So let's start here. Let's once define this, because without defining this tool, you won't be able to understand what I'm saying. So in a short position tool, we have two parts. We have the green part. The red is always at the top. There are two. Let me just put them right here. We have a long position tool and a short position tool, like that. Long position tool and a short position tool. So a long position tool, or let me start with the short one because this is right. It's the first one right here. So a short position tool means that I the price of that asset to go down. Okay? And in a long position tool, I expect the price of that asset to go up. Perfect. So it means if the price of this asset, right here goes up, am I in profit or in losses?
You're in losses.
Perfect. So, and in the case of this one, if the price goes down, am I in profit or in losses?
You'll be in losses.
Perfect. So you've gotten up to that part right there. So this long position tool, this short position tool, this red zone is my loss zone, my losses zone, and this green part is my profit zone. The same thing with an uptrend or long position tool. This green part is my my profit zone, and the red part is my loss zone. So higher, let's go. So this part right here, this one, this separator, the separator between the loss zone and the profit zone, same thing to this part right here, is my entry price, my entry. Okay. No wonder you saw I took this because I want to buy this at this 50% of this both two conferences. So 50% of these two conferences. So the So if I put my long, what does this mean? That when price will come into this zone of 104,327, I'll be triggered at that price. Yani, I'll have bought that
at that price. That's why I want to know. So you put just delete it and then put it again. Draw a new long position.
Short
or long, whichever.
Another one.
Yeah, do it on the chart.
So what you do, just come on the click it like that. It will appear somewhere. Here it is. You see?
Okay.
So I'll drag it to my zone, my interest zone right there.
So you match the where the separator is with the 0.5.
With my interest price.
Okay.
Then I'll have my take profit to my interest price. Remember, my interest price is also here. This is my exit price. So right there. Then I can have my stop loss. We'll talk about stop loss, but at this part, let's just guess that our stop loss is that right there. But we'll talk about stop loss and how to determine a good stop loss. So let's guess it's the right there. So what does this mean? It means when price comes into this zone, I'll be triggered. Okay, I'll be triggered. And my price is 104, 333. So if price continues to go down like this, I'll be in profits. I'm still in profits. Oh, I was naming this part. We have named this part. This is our entry. Don't confuse. This is our entry.
Okay.
And this is our entry.
Yeah.
So this, the last part right here on my red zone is my stop loss.
Stop loss.
Stop loss right here. And this part right here will be my stop loss. Okay?
Yeah.
Aya. What do you mean by stop loss, Lai?
Stop loss means that that in case let's say for example I am buying or making a buy, if it reverses back, instead of it going all the way and not much losses, it's a point at which it should stop, like it should close the market for me.
Yes, perfect. So that's my stop loss and that's my stop loss. Then this is my take profit.
Okay.
This one right here is my take profit, and this one right here is my take profit. Sawa.
But I saw you pulling the green part to where you want it. So it doesn't automatically give you
no
the exact point.
No, you have to determine these points on your own. Remember, I've done my analysis and I want to get out of the market. When price comes to this bullish order block, I want to collect my profits at that juncture. So I'll just adjust my long position tool to that point and my stop loss at that point. So it means if price goes down up to this part right here, my target is to take profit. I'll get out of that market with a profit. But if price goes against me, I'll be stopped out at this point. Instead of carrying so many losses and maybe getting liquidated by the market, I'll be stopped out at this juncture. Is that okay now?
Yeah, I understood.
Yes.
Thank you.
Any other question? Any other question? We look at the, we've basically talked about FVGs alone. So we are remaining with stop hunt and the Quasimodo pattern, but we can do that tomorrow. I have another meeting. Any question, Emmanuel?
Can you please make a brief summary of what Confluence was? I had a small shortage, so I was stopped during class. Yeah, just a summary of what Confluence was.
Can I do this because I'm running late? Do this as I'm doing that on a class, and we upload this recording, then you can reward me.
Okay, no.
By 11, the video will be up.
Okay.
Yes, you can reward that part. Is that okay?
Okay, it's fine.
Okay. If everything is clear, that's up. Okay, so perfect. So I'll end this class at this juncture. We meet tomorrow for stop hunt and the Quasimodo pattern. Otherwise, guys, have a good night and be blessed. Bye.